Let's move on. I'd like to introduce to you all our second speaker, Thomson Naude, who is the CFO of Carnarvon Energy, ASX code CVN. Thomson has approximately 15 years of commercial and financial experience. He is a chartered accountant with experience in auditing, financial reporting, raising capital and commercial transactions, including the divestment of Carnarvon's Thailand production assets and the Buffalo farm out. Ladies and gentlemen, I give you Thomson Naude from Carnarvon Energy.
Good evening, everyone. So just quickly, Damien touched on what Carnarvon's based on, but we're a Northwest Shelf focused oil and gas company. We have a market cap of around $400 million, and having just completed a capital raise of $70 million, our total cash is around the $120 million mark. So we're relatively cashed up, ready to undertake the sanctioning of our Dorado Project later this year. That Dorado we discovered back in 2019. Our partner was Quadrant at the time, who is now Santos. An absolute staggering discovery, and I'll talk you through the impact of some of that later. I call it absolutely staggering because Fred Weir, the former head of exploration of Quadrant, was here, and I think that's what he called the discovery at the time in the press. Pretty short presentation today, so I'll focus around the Bedout and Dorado. Carnarvon does have a series of other exploration prospects in the Northwest Shelf, and we are also undertaking a renewable diesel opportunity in Narrogin, where we're in the process of front-end engineering and design right now. I thought I'd start on the thematic of world energy supply. What's happening in the oil market right now? I'm sure all of you have been at the petrol station seeing the price of a litre of petrol, around the $2 mark. And if it wasn't for the government excise, you'd be paying well north of excise reduction. You'd be paying well north of $2.50 per litre. And it's simply because, as a globe, we've been underinvesting in oil and gas, and oil particularly, for almost 5 years, or even 6 years now. So what has happened then is we're in a serious deficit of production and demand. Now that it's recovered post-COVID world, we simply cannot satisfy demand. This has now been accelerated by the fact that Russia is sanctioned. The European Union last night announced that they will not be taking Russian crude from next year. That hasn't even been accounted for in this chart, and China is only going to wake up from their COVID restrictions, adding extra pressure to what's happening in the oil price. So here you can see Dorado. We're expected to commence production in around 2026. We're in late stage engineering now. We'll sanction the project coming this year, and all you can see is this deficit is going to continue through the future, and when we're at first oil, we'll be in a very strong position. And I'll explain to you why that's important in a moment. But just going into Carnarvon and the Bedout and Dorado, here on this map here, you can see Dorado in green, which signifies it's an oil field. That was our discovery of over 150 million barrels of light sweet crude oil, highly valuable stuff. And recently we undertook a drilling program, and we drilled both the Pavo and the Apis wells. And interestingly, we heard about oil migrating just before. It did indeed migrate out of Apis, so that was not a success. But Pavo itself was quite successful. So the way we drilled these wells, we drilled Pavo first. We saw an incredible rally in our share price. We got to 42 cents. We raised our capital, went and drilled Apis. We were at about 32 cents at the time. Post-Apis, the market completely overreacted. There was a big sell-off by speculators, and we're down at 22 cents per share now. I think we closed at 23 cents per share today. So there in itself probably tells you lies quite a big buying opportunity in Carnarvon. In fact, our enterprise value right now is less than it was before we made the Pavo success. And in a sec, I'll explain to you why that's quite important. So, coming to Dorado. This is what Dorado's production profile looks like. Initially, it might look quite disappointing, but this is what all oil fields do. They start producing really hard, and then they decline over time, and they tend to decline fairly quickly. In saying that, at today's oil prices, the The project pays off in year one. That's right, this project pays back in year one. So to take you through the economics, this project is going to cost just over $2 billion to build. Carnarvon is 20% of that. Santos is the operator and the remaining 80%. We'll build that for $2 billion. Operational costs for a project like these are fairly negligible. It's somewhere in the order of $80 million per annum. This is all in US dollars, by the way. And we pay back in year one, and it's cream from there. Initial capacity in Dorado is going to be 100,000 barrels a day. So if you take that, and what it gets you is production in year one is about 30 million barrels. Oil price $100 a barrel. It's 110 today. That's $3 billion. So it's actually making $500 million profit in year one, and thereafter it is all profit from there. So Pavo discovery was about 40 kilometres east of Dorado. And what we do here is we will simply tie that back to the Dorado facility in time. And I'll show you on the next chart how that looks against Dorado. But it's a relatively simple development. We'll put a platform in, a couple of wells, and that development there is in the order of $500 million, giving us a capex cost of $10 a barrel. So comparing that back to Dorado, it's $15 a barrel. So we're already getting cheaper as we started to step out and find new resources and tie them back to our Dorado facility. The facility already exists, and as you can see on the previous slide, we've got capacity from year 2 onwards. Then, following that, we have another structure called Pavo South, which is another 40 to 50 million barrels of oil of prospective resource. The Pavo discovery was 43 million barrels. So when we add that to the Dorado resource, we now have over 200 million barrels of light sweet oil in this area. So Pavo South, because the pipeline has been built back to Dorado, we don't have to build another pipeline, we just back it into the same thing, and it's another couple of wells tied right back into the Pavo platform. That's bringing that capital cost down to $5 a barrel. So where we are today, at $110 a barrel, we're making 105 profit per barrel. OPEX does not change because it's already coming back to the facility at Dorado that's producing. So it's really just high profit barrels. And this is to demonstrate what it looks like. So back to Dorado, it's paid back in year one. We bring Pavo North in immediately after that. We've already started engineering studies on that asset. It's all looking pretty good. So that comes in from year 2 to 3, maintaining that 100,000 barrel per day production rate. So, and we think back to the simple maths there, 100,000 barrels a day equals 30 million barrels per annum, which equals $3 billion of revenue per annum. And we've already sunk all that capital. We don't have to build much more, except in Pavo's case, another $500 million. That, at today's rates, pays back in about 2 months, and it's all profit from there. Basically, this thing is going to generate a lot of income, a lot of revenue. It's going to create so much franking credits, and I can see there's a few people here that seem to be fond of their franking credits. It'll generate a lot of that. Do a lot of good things for the Australian community, a bunch of taxes, and frankly, we'll be paying dividends on this asset. In summing up, we went back to going back to the start. It's an incredibly opportunistic moment to be a Carnarvon shareholder and to be a new shareholder in Carnarvon. What we saw following the drilling of APIS 1 is there was a complete overreaction. We've had a sell down from 32 cents down to 22 cents. Our enterprise value is lower than it was before we discovered the Pavo resource. And you can see there what the economics is going to do to that asset there. We're going to be generating a gross profit of $100 per barrel on Pavo, and that has not been recognised in our share price. Oil prices are strong. They're $110 per barrel at the moment, and places like China still have to get out of COVID. There's going to be continued demand. There aren't any genuine replacements for the Dorado crude type. Particularly in Dorado, there's a very high naphtha cut. Naphtha is used to make plastics and other elements that we use in everyday life. In fact, Teslas are made out of naphtha. So if all these electric vehicles that will exist, they'll need Dorado crude to make these cars. So Carnarvon, we've prioritised oil. While a $2 billion development sounds like a lot, it is paying back in year one, and that's really important. Pavo being so close to Dorado, it just creates such a high cash flow. We can bring it in from year 2 to year 3 and extends our returns and returns for shareholders. In that basin map where I showed you earlier, we've got over 100 prospects in that area. We've only had 2 wells out of 10 here that have not been successful. So over time, we'll continue drilling. We're in the midst of formulating our drilling program for next year. We will drill Pavo South and shore up those additional 40 to 50 million barrels, and we're hoping to drill some other larger prospects. I think we'll chase something over 100 million barrels, so quite substantial. And we look forward to sharing more news on the forthcoming drilling campaign shortly. So in summarising, Carnarvon, very valuable stock to hold. Its foundation asset Dorado plus Pavo isn't even accounted for in the current share price. Plus, as a shareholder, you'll enjoy other moments to appreciate share price gains as we do more drilling throughout 2023 and beyond. Thank you.